All right, let's jump right in. There's this theory making the rounds about a potentially huge surge in the price of silver. But the real twist here, the thing that makes you kind of lean in, is the main character, JPMorgan. You know, one of the most powerful banks in the world. And this theory suggests they might be quietly getting ready for this exact event. So today, we're going to break down this silver squeeze idea and see what's really going on.
Okay, before we get into the thick of it, just a super quick but really important heads up. This is not financial advice. Not at all. What we're doing here is analyzing a specific theory, looking at the data and arguments presented in our source material. The goal is to understand the thinking behind it, not to tell you where to put your money. All right, let's go. Okay, so let's get to the absolute heart of this thing. The entire argument, the whole theory really pivots on the actions of one single massive financial institution, JPMorgan. And this is the question at the core of it all. You have to ask yourself, why? I mean, if silver is just another industrial metal, why would a bank like JPMorgan be making such a huge long-term play for the physical stuff? The analyst behind this theory believes the answer points to something really big coming down the pike. So, how big of a move are we talking about? Well, according to the analyst's research, JPMorgan has piled up a staggering 675 million ounces of physical silver. To give you some context, that's not just a lot, that is more than the infamous Hunt brothers held at their peak, and it's more than many countries hold in their national reserves. It's a huge, huge pile. Now, what's fascinating isn't just the size, it's the strategy. This wasn't some snap decision. They've apparently been at this since way back in 2011. But here's the real kicker. After the 2008 crisis, the bank ended up with a massive short position, basically a giant bet that silver's price would fall. But as you can see, they did a total 180. They went from betting against silver to making a massive bet for it, and in the process, they become maybe the biggest player in the market, controlling a huge slice of the available physical supply. So again, you've got to ask, why the big flip? Well, the analyst argues JPMorgan isn't just taking a random shot in the dark. They're positioning themselves for a historical pattern they've seen before, a four-stage cycle that, they claim, has played out right before almost every major financial crisis. So here's how the pattern goes. Stage 1 is the setup, where everything looks fine and dandy, and paper promises are flying everywhere. Then comes the expansion, where the gap between all those paper promises and the actual physical stuff gets wider and wider. The tension builds until you hit the break. Some catalyst hits, and suddenly everyone makes a mad dash for the real physical asset. And that, my friends, leads to the final stage, the eruption, where the price just goes vertical as everyone scrambles. And here is the punchline. The whole point of this analysis isn't that this might happen someday. The argument is that the silver market is in stage 3, the break, right now, and is staring right over the cliff into stage 4, the eruption. So to understand why anyone would think we're at a breaking point, you have to get this fundamental tension at the core of the market. It's really a tale of two completely different markets, the paper one and the physical one. And this right here shows you the problem on the physical side. Industrial demand for things like solar panels, electric vehicles, 5G, you name it, now makes up nearly 60% of all the silver we use. At the exact same time, the supply coming out of mines has actually been falling. For years, we've had this, what they call a structural deficit. We're consistently using more silver than we're digging out of the ground. Simple as that. So you end up with this totally weird dynamic. In one corner, you have the paper-silver market, this whole world of derivatives and contracts that some analysts think is maybe 50 times larger than the actual physical market. Then in the other corner, you've got the physical silver market, where real-world demand is literally draining vaults and supply is getting tighter. The theory argues this disconnect, this giant mountain of paper promises sitting on top of a shrinking pile of real metal, it just can't last forever. The source then looks back through history for some clues about what that final eruption stage might actually look like. And yeah, there are some pretty dramatic examples. Take the famous story of the Hunt brothers back in 1979. They saw the same things people are talking about today, high inflation and a supply deficit, and they just started buying physical silver. The result? An absolutely mind-blowing price run, from about $6 to almost $50 an ounce in just over a year. The only thing that stopped the rocket ship was the exchange itself, stepping in and literally changing the rules of the game to force them to sell. And this is the key thing to take away from the whole Hunt brothers story. It's not that their idea was wrong, it's that their analysis was spot on.
The underlying physical shortage was completely genuine, and for a minute there, the market price actually reflected that reality before the rules got changed. And we saw a more recent version of this in the 2008 financial crisis, right? When faith in all those paper assets like mortgage-backed securities just completely evaporated, where did investors run? They ran for the safety of physical assets. Gold shot up 167% in the aftermath. It is the exact same pattern. When faith in paper promises breaks, money floods into tangible, real things you can hold. So that brings us to today. If the theory holds water and the market really is in that final phase, what could this so-called eruption actually look like? Well, the analyst points to a few price projections, and this is where it gets really interesting. If you look at this table, the mainstream targets from big banks like Citibank and even JPMorgan themselves, we've already blown past those. But the other models, the ones based on historical patterns, like the inflation-adjusted 1980 peak or a return to the historical gold-to-silver ratio, well, they point to much, much higher prices. We're talking well into the triple digits. So what could be the spark that lights the fuse? According to the source, a potential trigger is just days away. The U.S. Federal Reserve is meeting to decide on interest rates, and that decision could be the domino that gets this whole thing moving. And if you look at the markets, they are overwhelmingly betting on a rate cut. Historically, that's a really big deal. Rate cuts tend to make the US dollar weaker. And when the dollar weakens, investors often flock to hard assets like gold and silver for safety. That pushes their prices up. The source argues this could be the exact catalyst needed to kick off a major move. But let's just zoom out for a second, because the final point here is probably the most important one. This theory isn't really just about silver. It's using silver as a kind of canary in the coal mine, a warning signal for a much bigger issue, our collective confidence in paper currencies, which are ultimately backed only by faith, not by anything physical. And so the analysis leaves us with this one big provocative question. It ties together everything we've talked about: the physical deficit, the massive paper market, the echoes of history, and the positioning of a major player like JPMorgan. Now, whether this theory actually plays out or not, it definitely forces us to ask some hard questions about the deep fractures between our financial promises and our physical reality. And that's a question worth thinking about.